The Bank of Canada raised rates by 50 basis points today, leaving their key lending rate at 4.25%. Now, the Bank of Canada is facing a huge dilemma right now. They basically have to decide between saving the Canadian housing market or the Canadian dollar. Let me explain. Now, mortgage prices have gone up and housing prices have fallen down as a result of the Bank of Canada raising rates a bunch this year. And if they continue to raise rates, they could cause a housing market crash. We're already seeing signs of stress with consumers relying on credit cards to pay for a lot of their bills right now. On the other hand, if they stop raising rates, the Canadian dollar will plunge, and that will make the cost of goods go up. In the winter, Canada imports a ton of fresh produce from the US, and these goods are highly affected by the Canada-US exchange rate. The lower the Canadian dollar, the higher the cost to import this food. Now, the Canada Food Price Report is already forecasting that food prices will rise by 5 to 7% in 2023. This is already after food prices have risen by 10% in 2022. And if the Canadian dollar falls below 70 cents, we could see food prices rise even further. So what's it going to be, the housing market or the Canadian dollar?